Assalamualaikum warahmatullahi wabarakatuh. We are from Group 7. Today we will present about Panasonic Manufacturing Malaysia Berhad. First, let me explain about the company's business and industry. Panasonic Manufacturing Malaysia Berhad was founded in 1965 in Shah Alam, Selangor, and it has a long-standing presence for more than 30 years since it was first established under consumer product and services sector. As we know that this company is very dominant in electrical goods industry, and it involved mainly in distribution, sales and also marketing of Panasonic brand of electrical appliances. And this company aimed to strengthen their position not only in domestic market but also in export market, especially for key product like we have here ceiling fan, kitchen appliances and also home shower. And here are some information about the company's related party. The company actually has many related party relationship with its significant investors, associate and also subsidiary. And here Panasonic Malaysia Sendian Berhad is an associate, while Panasonic Corporation is its ultimate holding corporation which incorporated in Japan. So with regard to its major customer is Panasonic Logistics Asia Pacific and Life Solutions Company Limited, at which these companies contributed more than 10% of the company's total revenue in 2021. And also in 2021, domestic sales contributed 35%, while sales made in Asian countries such as Thailand and Singapore contributed 33% of the company's total revenue in 2021.
In determining the materiality level, we will use profit before tax as a benchmark because it is a critical item for the profit-making organization. Furthermore, the company's profit before tax level is relatively high and stable from year to year, making it suitable to be used as a benchmark due to its low volatility. Based on the rule of thumb, the common percentage used is between 5% to 10%. Thus, our preliminary judgment about materiality will be based on 9% of net profit before tax because we believe that the company is an experienced company as it has been operating for 30 years and it also has effective internal control resulting in a lesser chance of fraud. From the calculation, it can be concluded that if combined misstatements are lower than Rm 12,163,590 at the end of the audit, the statement will be considered fairly stated. In contrast, if the combined misstatement is more than the preliminary judgment about materiality amount, the statement will not be considered as fairly stated. The next step is to determine performance materiality. The performance materiality amount in each segment should be less than the materiality level of the financial statement as a whole in order to reduce the possibility of unidentified misstatement that exceed materiality for the whole financial statement to occur. The allocation of performance materiality is governed by two arbitrary conditions. Firstly, for any account, performance materiality must not exceed 60% of the preliminary judgment. Secondly, the aggregate of all performance materiality levels cannot be more than twice the preliminary judgment about materiality. Performance materiality will be allocated to the statement of financial position instead of the statement of comprehensive income because most of the misstatement that occurred in the statement of financial position has the same impact on the statement of comprehensive income because of the double entry nature in accounting. We have divided the performance materiality into three sizes, which are small, moderate, and large. Small materiality level is allocated at 3 and 4% of twice the preliminary judgment about materiality because these accounts display minor or no changes from the previous year. Thus, no misstatements are expected. Next, moderate performance materiality is allocated at 6 and 8% because some of these accounts only dealt with a few parties and display fairly large changes from the previous year. Thus, a relatively moderate amount of misstatements are expected. Large performance materiality is allocated to the cash and cash equivalent account at 13%, since this account consists of large amounts and need substantial sampling to audit this account. As for retained earning, no performance materiality is allocated because it is a residual account that is affected by the net amount of the other accounts' misstatements.
I will further explain about the assessment of inherent risks of the company. There are three risks that we have identified. Number one is the nature of the business. As the company is electronic manufacturer, it faces a greater probability of obsolete inventory, which lead to the higher inherent risk. Furthermore, the market of home appliances, especially in Asia Pacific, are projected to grow due to the customer preference and technological advancement. To add, the increasing standard of living will encourage the consumer to buy the smarter version of appliance. This will result the product life cycle of the company for home appliance becoming shorter. Thus, the inventory becomes obsolete much faster. Furthermore, if the inventories are unable to sold, they will decline in value and can cause large losses for the company. Since Panasonic is a well-known brand, the integrity in maintaining the sales volume of their product might lead them to mistake the inventory account to meet the expectation of shareholders. The second inherent risk is related parties. We have identified that the company has 37 related party relationships with its holding company, significant investors, subsidiaries, and associates related to its holding company, and key management personnel. Based on the client's annual report, they have engaged with Panasonic Appliance R&D Center Asia Pacific Southern Berhad to make a research in developing a new technology in sustainable engineering. The increased transaction with related parties will raise the inherent risk due to the lack of independence between the parties involved in the transaction, intercompany transaction, and opportunities to engage in fraudulent financial report. The last inherent risk is complex transaction. During the year 2021, the company is undergoing the construction of the factory building. The factory mainly uses the energy-saving facilities, which are regarded as large property acquisition, which is not routinely done by the company. The construction of the factory required the accountants to keep and record multiple complex contracts. Also, the company has acquired several derivatives, which is one of the complex investment due to in the underlying risks. The lack of experience in recording such transactions will lead to the higher inherent risks. The inherent risks that I have mentioned before have the specific effect to the audit procedure. Number one, the auditors must thoroughly audit the inventory to check its existence and occurrence. This can be done by visiting the company factory and facilities and physically observing the inventory to determine whether the recorded inventory exists and is correctly counted by the company. Number two, assess the ability of the clients in identifying and responding to the risk. And last but not least, the engagement might need more experienced auditors to ensure the audit procedures are smoothly executed.
Now, we will move into a preliminary analytical review starting with a statement of profit or loss. Panasonic Manufacturing Malaysia Berhad's performance has deteriorated quite a bit in 2021 compared to 2020. As you can see in the statement, the revenue generated by the company has reduced by about 77 million ringgit and become the major cause for the decrease in profit for the year in 2021. Other than revenue, the decrease in profit is also caused by decline in other operating income and increase in other expenses. At the end of 2021, the company managed to get profit of 116 million ringgit and 454,000, which is lower by 535,000 ringgit from 2020. Now, we will look into the reason behind the decrease. First is revenue. Most of the reasons behind the decrease in revenue is caused by the measures taken by the government to curb the spreading of COVID-19 pandemic, such as lockdown and movement restrictions. The company cannot continue with their production, has to close down for a while for sanitization purposes, and installation for the products cannot be done. Besides that, sales from the Asian markets also declined.
However, the decrease in revenue managed to be reduced since export sales in the Middle East have risen in 2021. Next is other operating income. It has decreased by 54.59% due to foreign exchange differences. Another reason is other operating expenses that has increased by 5 million ringgit, which is more than 100%. The expenses have been incurred in order to mitigate the decline in the performance of the company to a certain extent. Other than that, we have finance income that has decreased by 9 million ringgit, which is equal to 48.87%. It is caused by lower amounts of deposit placed since a lot of funds have been used for payment of dividends and capital expenditure. Besides that, the interest rate has been reduced by 0.8%, which is from 3% to 2.2%. The last one is the share of results of the associated company that has increased by 20 million ringgit because there are a lot of activities that cannot be conducted which lead to lower sales, proportional and advertising expenses. Now, we move on to the statement of financial position. From the statement, we found out that the assets, liabilities and equity in 2021 has all decreased compared to 2020. Total non-current asset increased by 9.54%, but total current asset decreased by 3.87% and total asset decreased by 0.42%. One of a few accounts that I would like to highlight is interest in associated companies, since it is an account that has increased a lot in 2021, which is by about 17 million ringgit. The auditors should inspect the records and documents that contain the information on the company's shares in its associates and subsidiaries to make sure of its existence and the accuracy of the amounts stated. Next is derivative financial assets that have decreased by about 89%. This account also should be inspected to make sure of its existence and accuracy. After that, we have inventories. There's not much difference in the inventories, and sales of the company have decreased quite a bit over the years. Therefore, we assume that there will be risk over the valuation of the inventories caused by obsolete and slow-moving inventories. Hence, auditors should test its net realizable value and find out the possibility that the company might have overstated the carrying value of the inventories. The last one is on cash and cash equivalent. It is an account that holds a huge amount of money and is prone to be miscalculated. So it will be best if the amount will be recalculated by the auditors. Moving on to liabilities. Total non-current liabilities has decreased by 4.58%, current liabilities decreased by 0.19%, and total liabilities decreased by 0.21%. Account that will be highlighted is the provision for liabilities and charges account. Provisions are usually made based on assumption made by the management. Therefore, the auditors should observe and find out how they come up with their figures and later determine whether the figures are appropriate or not. As for equity, there's not much difference aside from a decrease in retained earnings, which contribute to a 0.47% decrease in total equity.
For liquidity ratio, we will measure company's current ratio, quick ratio, and cash ratio. Current ratio illustrates how the firm might use its current assets on the balance sheet to pay off current debts and other obligations. In both 2020 and 2021, the level of the company's current assets is 4 times higher compared to its current liabilities. This indicates that the company will be able to convert its current assets into cash at a faster rate to pay off its short-term debts efficiently. The high current ratio in both 2020 and 2021 is due to the cash and cash equivalent account, where it makes up around 79% of the company's current assets. Next, the slight decrease in 2021's current ratio is mainly due to a sharp decrease of the accounts under current assets, named derivative financial assets, which has decreased by 89.36% from 2020 to 2021, which lead to a substantial reduction in current assets. Nonetheless, despite the fact that the company's current ratio has decreased, it has no effect on the company's ability to satisfy its short-term obligations and poses no going concern risk. Secondly, the quick ratio measures the company's ability to meet its current liabilities using its most liquid assets without taking into account the inventories. This is because inventories are less liquid as they cannot be easily converted into cash within a short period of time. The quick ratio for 2020 and 2021 shows a satisfactory liquid position because liquid assets for both years are higher than current liabilities. Thus, the company will be able to pay its short-term obligations by using its most liquid asset is cash ratio, where it measures the company's ability to repay its short-term obligations by using only its cash and cash equivalent. The calculation above shows that the Panasonic Manufacturing Malaysia Berhad has a high amount of cash as it makes up a significant portion of the company's current assets, which are around 79% in 2020 and 75% in 2021. Furthermore, the difference between the previous and current year's cash ratio is small, thus the risk associated with cash is low as a result of the small variation. The risk of cash theft will also be reduced because of the company's strong internal controls.
For profitability ratio, we have focusing 5 items, which are basic earning per share, gross profit margin, net profit margin, return on asset, and return on equity. For basic earning per share, it shows how much the firm's net income was allocated for each share of ordinary share. Both years show the positive EPS at 1.93 and 1.92. Due to the company being able to generate profit, there is no significant increase in other expenses between those years. Also, the decrease of EPS by 0.01 is due to the decrease in the net profit for the financial year attributable to the equity holders. The gross profit margin are used to indicate how efficient the company managing its operation. Both net sales and cost of sale declined by 7.36% and 6.99% respectively, resulting in a slight decrease in gross profit from the year 2020 to 2021. The gross profit margin for the year 2020 is 19.012%. This means that 80.988% of the company's profit were used for the cost of goods sold or to manufacture the product that the firm produced, and the remaining 19.012% are used for other expenses. Meanwhile, in 2021, 80.313% of the profit was used to manufacture the goods, and the remaining 18.687% were for other expenses. The low rate of the gross profit margin shows the inefficiency of a company in producing their product. However, since the products manufactured by Panasonic Manufacturing Malaysia Berhad mainly use high technology, which is costly, the low percentage of gross profit margin is acceptable. Next, for net profit margin, it measures the amount of net profit a company obtains per ringgit of a revenue gained. There is an increasing rate from 2020 to 2021 by 1%. In 2020, 11% profit margin means for each 1 ringgit of revenue, the company earns 0.11 ringgit in net profit. Meanwhile, in 2021, a 12% profit margin indicates for each 1 ringgit of revenue, the company earns 0.12 ringgit in net profit. The low net profit margin might be due to the high cost in production. Return on asset measure the efficiency of company assets to generate the profit. There are relatively small changes in the ratio from 2020 to 2021 due to a slight decrease in net income. This might also indicate that the company constantly used the same initiative in deriving the profit using the company's asset. Since the ratio for both years is above 10%, it is considered good for a manufacturing company. Return on equity is a simple tool for evaluating investment return. The share capital amount for both years is the same at 60,746 ringgit, indicating there is no issuance of new share or disposal of current shares. Since the ratio is above 10%, the company's profitability is considered in good condition.
Next, the effect of COVID-19 pandemic on the company's performance. Generally, the pandemic has badly affected the company, and the area that we want to highlight here with regard to the revenue, because the revenue has shown a reduction of 7.4% or 77.4 million compared to the previous financial year, and this is because of the low domestic sales and also in Asian markets such as Brunei and Thailand. And the main reason for this reduction is because of the lower production volume and sales, because Malaysian government has ordered movement control order in March last 2 years, and also because of the closure of its factories for sanitization activities that contributed the most to this reduction in revenue for financial year 2021. To conclude, audit planning is actually very important for auditors to ensure that only reasonable cost is incurred and to avoid any misunderstanding. This also ensures that auditors obtain sufficient evidence to reduce audit and also engagement risk. That's all from us. Thank you.